somebody give us a sound check. Let me know if you hear me well. Just type in, and Anthony will let me know if I'm broadcasting well and you guys all hear me. Should be able to see the lead slide in my desktop. Sound good, Anthony? They all hear me?
Boris, they're saying sounds perfect, so we're good to go.
All right, so we're good to go. So we're going to dive right into it, guys, because we're right on time and very punctual. So I'm going to go to full screen. We're going to do, I'm going to tell Anthony to hit recording, and then we're ready to go. Oops, hang on a second. Oh, I'm looking at the wrong, okay.
Boris, we are recording now.
Awesome. All right, everybody, welcome to our first of many, many amazing webinars we're going to do with you on a monthly basis. This is Boris Schlossberg with BK Forex and Pepperstone. We love Pepperstone, as I've told you guys many times before. In fact, it's my primary reason for wanting to be an Australian or not wanting to be an American these days, since we, at this point, have nowhere left to trade at this point. So I'm very, very excited to be with you guys. I'm going to show you a couple of really interesting, really simple, high probability strategies. Feel free to ask me questions. We'll sort of divide the webinar into kind of each strategy will be sort of a pause, and then we'll take questions after the end of each strategy to make sure you guys absorb it. And I'm sure if you requested, we'll be happy to provide a PDF of this event so that you guys can actually get the written rules in a PDF format of this PowerPoint down the road if you like that. So it'll be nice and easy, and hopefully we'll do that with almost every single webinar we do with you guys on a monthly basis. So before we start, as always, past performance is not indicative of future results. Trading Forex carries a high level of risk, might not be suitable for all investors, and I ask you to read this disclaimer very carefully to understand all the risks associated with trading on margin, and to seek advice from an independent financial advisor if you have any doubts. So, as I said, you know, we love Pepperstone, and for some reason, I don't know why, I always think whenever I think of Pepperstone, I always think of Eddie Murphy. So I think I'm going to start the show with just a little bit of a Hercules route. Let's play this. Wait. No, come back to me. I was playing this before. I love this little clip. Hercules. I just thought Pepperstone is like that to me. It's like Hercules. So I thought we'd start with that little clip. And if you guys don't mind, you like that? Sorry. Okay, we'll stop Eddie Murphy for a second. If you guys don't mind, I can go full screen. But actually, you know what? I'll go full screen. It's easier to do it this way. It's fine. It's fine. And we'll just rotate the charts when I need to go to rotate the charts. So I want to start with a quote that most people find highly offensive, and in every other aspect of life, it truly is. But when it comes to us, it's actually extraordinarily complimentary. And that's, I think, the essence of my webinar today, is to make you guys understand that trading is actually understanding the value of nothing and the price of everything. So, you know, the original quote from Oscar Wilde is that nowadays people know the price of everything and the value of nothing, and it's often used derogatorily, usually against businessmen or capitalists who essentially value everything at price and not in human relationships. And it's absolutely true. In every other aspect of life, that is absolutely true. But when it comes to what we do every single day, I think it's extraordinarily important, and that's the reason why I bring up this quote, to understand that this is the only thing that matters. Your opinion doesn't matter. Financial data doesn't matter in the long run. Even Janet Yellen's opinion doesn't matter, as you can see as we'll see on the charts in just a little bit. It doesn't matter what people's opinions of reality is. The only reality that matters is price. Now, investors trade value. Investors will go buy a stock and they'll say, this is a great company. I like Tesla because they're going to be the future of transportation, or I love Apple because they own the world of computing. Or just Anthony and I were just talking about the fact that, I'm a huge Apple fan. I was telling him that, once he goes Mac, he'll never go back. But that has nothing, literally nothing, to do with what we do, because we are traders. And traders trade price. Investors invest in value. Now, one of the interesting corollaries to this is the place where everybody gets into trouble, is that once you start thinking of value as a driving proposition of what you're doing, that's when you get in trouble. Because what happens to us when we start thinking about value? We say, I bought yen 114, and now it's 1375. Oh, it's a huge value. It's even a better value at 1375 than it is at 114. I'm going to be buying it, for now, because for sure U.S. yields are going to go up. For sure, blah, blah, blah. For sure, Janet Yellen is going to tighten monetary policy. For sure, a million different things. Feel free to fill them in. I do that every single day on CNBC. So trust me, nobody knows how to manufacture reasons better than I do. But for trading purposes, we've now completely destroyed what it is that we do. We've turned ourselves from trader, which is someone who looks at price, into an investor, which is someone who thinks about value, and we've lost. We've literally lost. The moment you do that, you have lost at this game. And that's why you should take this particular statement by Oscar Wilde with pride. Yes, we only look at price of everything in trading, and we value nothing, because there is no value in anything that we trade. It's only price. So this is really what is the foundational philosophy behind trading naked, because it's all about trading price. It's exactly what Oscar Wilde has said. Price is everything, and we should be looking at price as our sole guiding principle for how we should trade. And this particular webinar is really all about how I personally do nothing but trade price. So, technical indicators, which is what all of us use, moving average, and by the way, I don't want everybody to think that I am against technical indicators, that this is some kind of a, doctrinaire, religious, argument here, a philosophical argument about the value of indicators versus price. There are plenty of people, including my own partner, Kathy, who literally trades the exact opposite of me. Her chart looks like I always kid around. Her chart looks like a spaghetti was flung against the wall, because she'll use 55 different moving averages and other derivatives and Bollinger Bands and everything else to look at charts. My point is, and it's actually ironic because I think it reflects the difference in our personalities. Because when we used to work together, like for years, literally like sitting across from each other. And her desk would be always a mess, and my desk literally would have nothing on it. And I think that's really my approach to trading is probably very attractive to people who are OCD. But if you like to have lots and lots of sensory input, then maybe this isn't the right way for you. But anyways, I think if you have a clean, tidy desk, maybe this approach will appeal to you. But technical indicators, which really go all the way back to Charles Dow, who created sort of the first set of technical indicators, basically are always backward looking. There is nothing wrong with that, but you need to understand that they are basically a commentary on what's happening in the past. And whenever you use a technical indicator, you are in effect saying, I believe, you were saying one or two things. If you're counter trending, you're saying the past is going to reverse, because at this point the technical indicator has exhausted itself, or you're saying the past is going to continue and maybe even accelerate because the technical indicator is showing me further strength. So as long as you understand that's the single driving operative thought of anybody who's using a technical indicator then you're fine. But I like to just use price, because ultimately every technical indicator is effectively nothing more than just a derivative of price, right? I mean, moving averages are derivative of price. RSI is derivative of price. Bollinger Bands are derivative of price. MACDs are derivative of price. CCI is derivative of price. You name it. Give me one. I'd like, just for fun, somebody throw out to Anthony if you can think of a technical indicator that is not a derivative of price. You know, I am it to him, and he'll call it out to me, and we'll see if you guys are right. But effectively, all of them are just derivatives of what you can see. Now, some people need visualization. They need to have a moving average underneath here to tell them this is an uptrend, right? But for me, I don't need any visualization because the price is telling me this is an uptrend, right? What is the price telling me here? We'll look at this just chart in a purely clean, simple format. What do we see here? We see obviously rising prices, but most importantly, this is the single greatest thing that I look for when I'm looking for an uptrend is what's the definition of an uptrend? It's a series of higher lows. It's not about the highs, right? I mean, the highs naturally go higher. They're going to go higher because it's an uptrend, right? What's important is, are they buying the lows? Every time that, because if you think about what's happening here, this is everything that you see on the chart is basically an auction system, right? So here, buyers decide they like this. They're buying it, right? So then early buyers decide, I'm going to take profits, right? So they take profits, and then more buyers say, ooh, this is a good bargain because I think it's going to go further. And they're buying this at a higher price than just was available, a couple of weeks earlier because they think there is something going on in the marketplace that makes me want to value this, right? This is the funny thing because, we trade price, but of course a lot of other people in this market are trading value, however you define value in their mindset, whether it's a central bank, whether it's a corporation, whether it's a hedge fund, right? And then they buy it again, and then then more late profit takers come in, and they can't bring it down, and until and unless they bring it down to recent lows, it's a buy. It's always a buy, and that's why the single greatest chart, in my opinion, the single greatest uptrend chart is one that has higher lows, and the single greatest downtrend chart is one that has lower highs. By the way, we're going to look at charts a little bit later on just for fun, and man, one of the things that fits that criteria is dollar yen. That is an ugly looking chart from the short side. It can't make fresh highs, right? And until it does, you got to basically sell. I mean, it's funny because one of the hardest things to do in trading is to actually trust your own analysis. I mean, I watch this all the time, and I still, to this day, you always go, oh, I can't believe that Yellen came in yesterday and basically was so bullish and was so adamant about doing 3 rate hikes that you kind of go, oh wow, maybe I shouldn't be short dollar yen, and yet it failed again, and if you simply trust your analysis, if you trust your own eyes, you will succeed. It's the hardest part about this is to actually trust the very simple rules that we've all set out for ourselves, right? In many ways, as Richard Pryor used to say, "Who are you going to believe, me or your lying eyes?" I always think that's what the market is always telling me. Anyways, so that's just price. That's really what we want to be looking at as a news line. Now, of course, and this is the 3 things that every trader should be aware of. And by the way, guys, just sort of to back up, to remove any confusion about the kind of stuff I do and the kind of stuff that I teach you. Everything I do, everything I teach you is effectively on a day trading basis. My time frame is the day. I open a day and close a day flat, right? That's my view. It's a personal preference. The reason why is because I love to control risk. I love to not be exposed to large moves. It doesn't mean that there isn't some really interesting longer term trades that you can make. And in our series of webinars, I'm going to be happy to share with you some really good long-term day trading, not day trading, but swing trading setups. But everything that I'm talking about here, especially in today's webinar, is really driven towards the day trader, the person who comes in and out during the day is going to make day trades. And if you're a day trader, there are three things that you absolutely must be aware of. Like if you don't know these things, you literally shouldn't be trading, because these are the ABCs. These are just the fundamental building blocks of day trading. You got to know the news. What I mean by that is not just, hey, what came out, what the news is of the day, who said what. You got to know what's upcoming, right? What's upcoming right now? What came out? Australian employment came out, right? It was a little bit better than expected, a little bit better revision, but unemployment rate, and participation was not as good, blah, blah, blah. Generally, mildly positive to Aussie, right? You need to know that. What's going to be coming out soon? Philly Fed. There's nothing in the European calendar today, so it's all going to be U.S. data. We have Philly Fed. We have weekly jobless claims. I mean, nothing really great on the forward calendar. But you need to know these things every single day. Like if you come to the screen and you don't know the major news events of the day, what's on the economic calendar, you really are not trading. You're gambling. You're the biggest sucker of all, because you're literally running straight into a train that's going to blow you over. Because if you're selling dollar yen in 5 seconds in front of Philly Fed, not because you believe Philly Fed is going to be weak, but because you don't know that Philly Fed is coming out, you're going to get rolled over. Certainly you're going to get rolled over yesterday if you were trading in front of U.S. retail sales. So being aware of news, and this is a very key thing. I always have this huge. This is a philosophical debate that I'm willing to engage in. I always have this huge argument with people who trade only technically and tell me news doesn't matter. Bullshit. Technicals don't matter. Technicals are completely immaterial most of the time. They're basically telling you the past. The news is what makes new technicals. The news is what makes new prices. The news is what creates this joint. Otherwise, the market would be in a complete equilibrium, right? It's news that creates fresh buyers or fresh sellers. So news really matters. You don't have to trade the news. You don't have to forecast the news, but you need to be aware of the news, even if you're a purely technical trader. So, I see it's 17 minutes into the event, and I already cursed. So I promise I will not curse anymore. Everybody who knows me knows I have the worst potty mouth in the world because I live in New York City. But anyways, I really believe that very, very strongly. So I want to sear that into your mind. If there's nothing that I leave you with today, with the addition of my setups, it's just that you need to be aware of the news every single day. You need to be aware also of the key trading levels. And the key trading levels are inevitably always the OO levels. Why are the OO levels important? Well, because, contrary to what you're taught in Guru 101, the big hedge funds, the big banks, and certainly Microsoft, certainly Apple, certainly, I don't even know, oh my God, I'm blanking out. Anthony, what's the company that makes those really comfortable Uggs, right? I was thinking of Australian company. Certainly Uggs couldn't give a darn about Fibonacci levels or the 100-point moving average. When they're doing their payroll, they're like, where's Aussie, 77 or 78? How much is dollar yen today? 112 or 113 for Toyota? The reason why OO levels matter is because the big money players, the big speculative players, and even the central banks all really key off the OO levels. And a huge part of our trading structure is designed around that particular dynamic. Human beings like order. Human beings like focus. And the penny levels is how people think about exchange rates, right? People like order. I always tell this story. It's a really interesting story. When I was in high school, I had this professor of drama. I took a theater course, right? God knows why. But he was one of the most fascinating, interesting individuals I've ever met in my life. So back in the days when I went to high school, which was like back when they used to have a horse and buggy, they everybody had an assigned seat, right? Everybody had to sit in an assigned seat that the teacher assigned you, right? But this was a class where we just came in the first day of the class, and he didn't assign any seats. He just was silent, and he let everybody choose their own seats. And everybody was kind of confused, and they kind of sat down, and they did. And this went for a week, right? This went for a week. And then the next week he goes, take a look at where you're sitting. And now tell me, was that the same place you were sitting in when you came here on the first day of the class? And it was. So what happened was we self-ordered, we self-naturally ordered without any instruction from him, and basically found comfort in the same seat that we had on the first day. And so what was fascinating about that, it was just sort of his lesson that the human mind always seeks order. Even in the midst of chaos and no direction, it always seeks order. And that's the power of the OO levels. Never forgot that lesson. And that theater professor, has made me lots of money through that lesson. The last thing is to always be aware of time of day. There are two really important times of day. Well, there are three because we're talking about Asia as well. But for FX market, let's be honest, there are really only two super important times of the day: the open of London and the open of New York. Right? Also, the close of London, which is midday New York, is an extremely important time. In the sense that you get a tremendous amount of volatility, and then everything settles down and becomes super quiet, right? So there's just nothing, nothing else happens. So being aware of what time of the day you are. So if you want to be volatile, if you want the biggest price action in the world, that would be 12 GMT until 12 plus 5, 1700 GMT? No. 12, 1300, 1400, 1500, 1700 GMT. I always got, God help me if I ever have to calculate GMT on the fly. It's so basically 7 o'clock New York to 12 noon New York is the most volatile time of the day. That's when New York and London intersect. You need to be very much aware of those, of that time frame as you go on. So these are 3 things, the ABCs of trading, that you need to understand in order to really, truly understand the market. So now that we've gone through the ABCs, let's take a look at a strategy that I have that I want to show you. And it's very apropos because this is a strategy that's actually really fresh in terms of timing for us. It's the London. It's what we call trading the London Open, right? Trading the market opens, which London Open just passed by us a couple of hours ago, so we can see how this strategy would have fared. Trading the market open is a very, very simple strategy. We call it the London break strategy, right? Nice little. Anybody go on this Ferris wheel? By the way, Anthony, nobody was able to give you a market indicator that is not price driven. I'm just curious. Did anybody try to rise up to that challenge?
One person put volume, and another answer was market profiling, and someone also said MACD divergence.
Yeah. Okay. MACD divergence, and it's all price driven because it's a derivative of a derivative of price. Volume, we don't trade in the FX market. So you're right. Volume is different from price. But since we're in an over-the-counter market, nobody sees volume in FX. It's effectively a non-issue. So a market profile is also a non-issue. I mean, if you're trading listed securities like futures or stocks, maybe you can find some value in market profile. I always find it really amusing. To me, nothing is more backward-looking than market profile. In other words, what does market profile show? First, you have a big burst in price, right? And then you have this huge volume. It's basically contemporaneous. In other words, volume is contemporaneous to price. So, boom, huge amount of buyers came in and price moved up higher. Wow, did I really need to know that the volume expanded? Of course, of course it expanded. 99% of the time, it's the same correlation. By definition, more people are interested, they move price higher or they move price lower, they create more volume. But maybe you guys have a more nuanced version of market profile. I've yet to sort of ever be convinced that market profile is anything but the most obvious, structure of exactly what happens in an auction-based market. But be as it may, it doesn't apply to us because we're in an over-the-counter market where volume doesn't exist. Anyways, let's get ready to rumble. Let's look at our first strategy, the London break strategy, right? Very, very simple. 0.5 to 0.700 GMT. So let me, God help me, I'm going to try to figure this out, Australian hours. What the hell is it, Australian hours, Anthony? We actually should probably, let me see. I mean, what would this be? What are you guys in GMT? What is Sydney to GMT? It's like
Well, Melbourne is GMT plus 11.
GMT plus 11. So let's add this. So it's 11. That would be 1600. Yeah, it's basically afternoon Melbourne, right? To 1800 GMT. Excuse me. Melbourne, right? Melbourne, as they say. Okay, so that's sort of where you guys should be looking at. I'm sure all the Sydney people are upset that I'm using Melbourne, but that's what we're going to use, right? So we're looking at that time frame. That's the time frame we're looking at. It's basically
It's game time, so I think they're okay.
Yeah, yeah. No, I know. I'm just kidding. We wait for the currency pair to make a range high or low by 5 pips. I'll go through the rules and then I'll show you visually because it's always much easier to show you visually, right? The stop is 20 pips and a target is 20 pips. It's very, very simple. We're looking for a breakout. We're looking for the breakout of the congestion before London, and I'll show you a couple of examples, and then I'll discuss with you why it works. So this is all on New York time, 1 o'clock in the morning to 3 o'clock in the morning to me, which is equivalent to 1600 to 1800 to you guys, right? So here, and by the way, let me just sort of add, this works always best. It's called the London break, and it always works best on the pound. It's designed for the pound. You can use it on the euro, you can use it on yen, but none of those pairs give you a clean, clear breaks. But they do work. It's not that I don't want you to dismiss them completely, but it's primarily designed to trade the pound. So here's the pound. Marx's here's a session. We do 5 points above this, about 104.45, and boom, you can see, it's a stop on entry. We're basically putting a stop entry to buy or a stop entry to sell, 5 points above, 5 points below the range. When one triggers, the other one goes away, and then we just ride this thing for 20 points with 20 points up. And usually, what happens is, it skyrockets. It doesn't take more than an hour and a half to kind of resolve in a direction of where you want to go, right? So here's one to the downside, right? 1 to 3 o'clock. Here's the bottom of the range. Breaks the bottom of the range, right? Breaks the bottom of the range. Does a little bit of a tease, comes back up into the range, but we have a 20-point stop, so more than enough. And then it just simply, dives all the way down. As you can see, it's all momentum driven. This is why I love these kind of trades. They go. They either go, or you're either done or you're out. Here's another one. Very, very clear. Very, very strong breakout. Post 3 o'clock, 5 points up and moves up, right? Here's another one that is more, let me see, no. Here's another one that I think Kathy brought out. I know why she did this. So the reason why she showed this particular chart is because this is why you use a 5-point filter, because the highs and the lows very often will get probed, right? Very often get probed, and you can get into a fake breakout. Don't rush this trade. This is really, really important. Don't rush this trade. If it's good for 5 above or 5 below, it's good for another 20, right? If it isn't, then most likely it's going to go back into the range. So don't rush the range. Let it drop all the way 5 points below before you initiate a trade. Because in this case, you basically wasted your money and wasted your time by jumping in a little too early. By the way, people always ask me when would I end this? Like if I didn't get a signal, if this was just literally a dead day, if this was a patient in a coma, what would you do? I would say by 7 o'clock New York in the morning, I would just abandon this particular setup. It's done. 7 o'clock New York is New York open. Nothing happened. We move on to better and different things. So what is 7 o'clock New York? That would be 2000 Melbourne. By 2000 Melbourne, you're out of the trade. Okay. let me just sort of again review. It's 1 to 3 New York, which is 1600, 1800 Melbourne. We pick our range, the highs and the lows. We give ourselves 5 points above, 5 points below to break, and then we just go for 20, 20, plus 20, minus 20 as our stop and target. Is that clear? Is there any questions on the setup as it's presented to you guys? Any questions from the audience? Because I want to.
Boris, there are a couple of questions that came in. The 20 points, is that an industry number, or is that a number you identified while you've been trading this style?
It's purely empirical. It's what we identified as a sort of a decent continuation. Trust me, the targets, you could get very sophisticated with the strategy. You could get it. You could sort of say, I'm gonna trade it with a 15-point trailing average, because occasionally, sometimes you get super big breaks, right? Like huge, 50, 60, 70-point breaks, and you're able to lock in some huge amounts of money if you use a trailing stop. What I want to offer you is the simple recipe, the clean recipe, the good recipe, and then you can decide how much salt and sugar and spices you want to add to it with your own management styles. What is important, what is really, really important about this particular recipe is you need to keep it at 1-to-1 risk-reward ratio, because this is a highly probable trade with close to 70% edge, as long as you don't lose more money than you win. As long as you can keep it even money on winning and losing, this is a highly positive expectancy setup. Whether you want to use, I wouldn't use any less than 10-10, because remember, especially in the pound, 10 points of retrace is nothing. 10 points of retrace is nothing. You got to give yourself 20 points of breathing room to make things work. Any other questions on this particular thing?
Yeah. So, what time frame are we looking at on this chart?
This is a 5-minute chart. It's a 5-minute chart. It could be a 1-minute chart. It really doesn't matter. Remember, the time that we're talking about is these 2 hours. You could use a 15-minute chart. It could be like 4 candles. All we care about is this particular time frame. And let's go back to today. Here's today, right? So let's look at this today. So this is the pound today, and this is 1 o'clock New York, 1800 Melbourne. 1600 Melbourne. And this is 3 o'clock New York, 1800 Melbourne, right? And we see the pound is basically bounded by 24.58 and 24.80. That's the range, right? Now, I express this in a 5-minute chart. You could express it in a 1-minute chart. You could express it on an hour chart. It doesn't really matter. All I care about is what's the highs and the lows of this particular time frame. 5-minute is a very easy, on the eye kind of a chart. It gives you a much more intelligent view of the price action. So I like to use the 5-minute. But the minutes, the chart, it's all about price. It's not about the chart. Any other questions on this?
Yeah. One more.
Yeah.
Do we only play the strategy when there's no news coming out? So there's a range to be identified.
No, the thing about so let's talk about why the strategy works, and this is a good example. So today, this is the pound, right? There is no news today, right? But remember, what we're trading basically. When does London news come out? London news comes out. Let me just move this over to you right here, 4:30 New York time, right? Basically, so I have like this whole hour-and-a-half window. So my strategy basically is very likely to take me up or down into a trade in the hour-and-a-half that between the actual news that comes out and the potential entry for the strategy. What this is all about is this. So this is 7 o'clock in the morning, London, right? Everybody's at their desks. They have orders from Hong Kong and Singapore that they need to do. They have orders that the London guys are leaving with them, and they have the first probative orders from London traders that are coming in here, and maybe even some Americans who are waking up early like me that say, hey, we want to establish positional views on where the thing is going to go. So This is what drives this initial impulse, right? It's everybody who decides which way we're going to take the pound in the first hour. Now, a lot of times, one of the interesting things about U.S. we have the news is people will shock of all shocks, front run the news in FX. Sometimes they may actually even know the news ahead of time. Another shock of all shocks. You ever wonder how like cable will go 30, 40 points, and the news comes out and it's positive, and you're like, oh, what a surprise! Insider trading in FX, which, by the way, is perfectly legal here because since FX is a non-exchange based product, there is no such thing as insider trading. You know, like if I had Janet Yellen's testimony in front of me a couple of hours earlier, I could have really made a nice amount of change in dollar yen. But you know, the point being is that the price tells you. This is the beautiful thing about the setup. You don't need to know the news. You don't need to know the actual news release because what you're doing is you're following, hopefully, the smart money into the right direction of the trade, right? Because this is all pre-positioned money that's basically betting on where the trade is going to go. So, of course, today they bet the pound. They're going to take the pound up. And the way this setup would have worked is 24.80 was the top. You bought 24.85, 20-point stop, 20-point target, and about an hour later, you got taken out at 25.05, right? It's typically a trade that lasts between an hour and 2 hours. And as I said, if it gets much past 6 o'clock New York time and you're holding it, just get out. At that point, it's done. If it's not done in the first 2 hours, it's not that interesting. It's actually the first 3 hours. Sorry, this is 3 o'clock. We do it at 3 o'clock New York. If it's not completed in this 3-hour time frame, get rid of it. It's not interesting. It should be completed within an hour or two of the time frame. That's the general expectation of how the trade works, right? So the other trade that I kind of brought up, wanted to show you, same kind of idea, not as clean and not as attractive, but still would have worked very nicely. Yen, by the way, yen has been money. I mean, if you guys remember how miserable yen used to be, where it would move like literally 20 points a whole day. These days, yen is the number, in my opinion, maybe even the number one currency to trade because that is the money currency. It moves 100, 150 points a day. It's got beautiful ranges, and it's a wonderful momentum trade. So if you look at the yen today, the low here was 13.83, right? We sell 13.78 as it breaks. Literally 5 minutes afterwards, they just decide to take the whole thing. And here, I think it gets done by, what is it, 63? Well, no, so it sold, no. So I sell 13.78. My target is 58. Sorry, my target is 58. So it gets done in about an hour, right? That's exactly right. It gets done in about an hour, and comes down a lot. Again, I leave the fine-tune details to you, whether you want to go for the full 20, whether you want to lock in 15 on your entry. It's up to you. On the pound, making 20 is relatively easy. On the yen, 20 is a little bit of a stretch. On the euro, it becomes much bigger stretch. On the Aussie, it's almost impossible because the volatility of the Aussie is literally 1/2 the volatility of the pound. So a 20-point move in the Aussie in an hour or two is far less likely than a 20-point move in a pound. You need to understand all those things when you trade it, which is why I showed it to you primarily on the pound as your number one choice, and then maybe as the yen as the number two choice. You only want to do this on high volatility currency pairs where a 20-point move is very feasible within an hour. You have to ask yourself, what's possible, right? That's the first question in trading. What's possible? And right now, what's possible is those 20-point moves in the yen and the pound, not necessarily in all the other pairs. Yeah. Back in the good old days when Aussie was above parity to the dollar and all the Australians were in New York City, literally buying out every single thing that was in the stores, that was a great time to trade the Australian dollar because it would move 20 points in a minute. But these days, at 77 cents to the dollar, it's just a slow poke of a currency that doesn't move more than a penny a week, right? And therefore, doesn't make it that interesting for us to participate in. Unfortunately, I would love to have seen it. I'm sure all of you guys would love to have seen it at parity or above to the dollar. So, London break. Everybody clear on this? Just want to make sure, because I want to get to the next one. We're actually Um, we can go just a few minutes beyond, right? If we have to. Um,
Yeah, I think so.
yeah, yeah,
However long you want to take it is fine.
yeah, yeah. Okay, because I thought I was going to be quick, but as usual, my motor mouth never stops, so I'm a little bit over time. But I just want to, this is the reason why we love doing these webinars. There's no pressure on us. We can totally hang out for as long as we want to, and I would much rather you guys fully absorb all of these concepts as cleanly as you possibly can, instead of us rushing into 5 million different ideas for you. So, anyways, we're clean on the break, right? I think everybody understands all the basic parameters. You have any questions, always feel free to email me. I'll be happy to answer them to you later. Next, the second strategy that I bring you, running for the OOs. I'm sorry for my scatological humor, but this was wonderful. This was Google Images. I was like, I got to have this image. This is the best image ever. So Kermit the Frog running the OOs. Anyways, this is another extraordinarily simple strategy. We can use the pound today as a good example of the strategy. Extraordinarily simple strategy that really works off of that whole 0-0 targeting momentum that we had. But what I'm going to bring to you today is some very interesting twists and turns to it in terms of money management that I think turn this into a super valuable strategy. As a matter of fact, the irony of the whole thing is that some of you may know, because we live, in the U.S. here, we basically, unfortunately, cannot have Pepperstone as a broker, which we certainly would have. FXCM literally went out of business, and one of the reasons why I could never trade this particular strategy in the U.S. is because the way FXCM structured their whole FIFO, LIFO trades. We could never manage multiple entries and exits. But now, actually, there are a couple of other brokers in the U.S. that allow you to do this. So we're actually going to put this. I'm going to put this strategy back into my trading room very soon, because this is one of my all-time favorite strategies that I was just literally hampered from doing unless I did it manually, and I just couldn't do it manually. And I want to go through all the details with you. So the idea is this. First, we're looking for the currency pair to start from the 50 level, right? And this is for the long side. We're looking for it to rise from 50 to the 80 level, right? So we need a jumping run. We need a start. We need the market to tell us the market is going up. It's looking, it's looking to run. Once it gets into the 80 level, right? It is within 20 pips of the OO. It's like in the penalty zone for the for soccer, right? I don't know Australian football, so and I love rugby. When I was in Australia, it was like I completely became obsessed with it. But I still don't know. In American football, it's called the red zone. When you're 20 yards away from scoring, you're in the red zone. You're in the hot zone, which means your probability of scoring really increases tremendously. Same thing in soccer. When you're inside the penalty zone, your probability of scoring a goal increases tremendously. It's the same idea for us as trading. Once we get to the 80, the probability of us running to the OO really increases tremendously. And that's what we're doing. We're trading the red zone, right? So we basically do a buy on stop. In other words, price rises to 80, then we're buyers at 80 with a stop at 20. And here's the key thing. It's a 1-2 exit structure in a perfect world. First, on the first half of the position, if it goes to the OO, we take our profit and we move the stop to break even, right? So now we don't have any risk on the trade. And the rest of the position, we target fully 60 points. Now, what that means is it's going to go to 40 on the other side, 40 on the other side of the trade, right? You guys with me? If you can achieve that, it's going to be a tremendously valuable setup. I'll explain to you the numbers in just a little bit. But the idea is sort of very simple. It's a 1-2 exit strategy. You buy at 80 on the long, stop at 60. First exit is at the OO. The stop goes to break even, and the second exit is at the 40 above the OO. Okay? I'll show you just a simple enter 80, take 20 over here. Here you buy the 80, right? You buy the 80, and profit target hit. Also, generally, it's again same kind of a thing. It's basically a 1 to 2 hour trade. it's not happening in 1 or 2 hours, beware. Get your guard up. Something, either you're in a very, very slow market day, or something is going on that's not happening. If they haven't moved it in 2 hours, the primary premise behind which you bought this thing diminished, is losing its power. It's like an ice cube. The longer you hold it in your hand, the more it's going to melt. So give yourself 2 hours maximum, I think, in this particular trade as far as time stop. You notice one of the things that are interesting about a lot of these setups is that they have a time stop as well as a price stop, right? So I think that's very, very important on a day trading basis. If stuff doesn't happen within generally 2 hours of your entry, you're either in the wrong trade, there is something going on in the market that that's unusual, and you should just pack up and go most of the time. Now, sometimes patience pays, but in trading, it's another one of those kind of things where reverse values rule. Patience is not a virtue in trading. In, out, done, collect my money and go home. That's how it should be. So here's one example. What should do here? This thing is a little bit cut off, I think. So here, this is another example. It's 36.80. We enter, and you see how quickly it verticalizes. You can see that once. And remember, who's the other party that's very active in the currency market? 35% of all trading is done by what? Algos. Actually, it's 45% at this point. Almost 45% of all trading now is done by algos, right? Algos are programmed. It's called an ignition algo. They're programmed to just basically sweep the offers and squeeze out everybody they possibly can on the stops. By the way, one of the setups we have forever is that once they hit the OO, they tend to take it right back down. So a lot of times you have a trade the opposite way. But right now, I just want you to focus on this particular way, which is they love to run it to the OO because they know that that's where a lot of stops are and also where a lot of people are targeting the move. The ignition algo very often helps you. Here's, by the way, look at this. This is another interesting thing. What happened here? You took this is the single worst trade ever to take. This is a trade I generally never take, and I'll tell you why, because this is so fascinating, right? Why is this the single worst trade to take? Is there anything wrong with the price? Is there anything wrong with the currency? No. The currency is an uptrend. We were buying the move. Sounds good. What makes this trade so absolutely horrible, and why it's almost a guarantee to fail? Or it goes from a 70% trade to like a 50% trade if you're lucky. Why? Anybody want to? Let's see, Anthony. Let's see if anybody can tell me why this is a horrible trade. Any guesses from the audience?
We have doji candle.
No.
It was a stop on.
No.
Time of day?
Time of day. Who said that? Give that man a donut. Time of effing day. This is New York time. 1300 to 1500. What happened here? Everybody is asleep. We're done. We're done, people. 12 o'clock noon. London goes home. They're already drinking in the pubs, right? And by 1300, New York is kind of done, right? Now, yes, maybe there's some kind of quirky movement that happens occasionally between 1400 hours and 1600 hours when New York Stock Exchange closes, but it's very rare. So whatever breakout happens is much more likely to be a fake out than a breakout, right? There's nobody to carry this. Who's here? It's 3 o'clock in the morning in Tokyo. It's like 8 o'clock in the morning at night. Everybody in London is drunk, and all that's left is a bunch of fat slobs out of New York City who are not going to be able to run this thing higher. So time of day is not your friend. This is where I talk about time of day. When does all the action happen? All the action happens here. All the action dies here. The charts tell you. It doesn't have to be doji, reversal or shooting star. None of that matters. It's all nonsense. All you need to worry about is price and time of day. Then you have a much better understanding of what's working. So that's why it was a stop. So short, same idea, but we're going to go the other way, right? If you think about trading as a sports field, right, with 100 yards or 100 meters, right? You guys have meters, right? So I'm actually curious. Australian football, is it a 100-meter field, or is it like some awkward number, like 110 meters or whatever? Anyways, the point being is if you think about the penny move and the effects, the daily move is about a penny as an athletic field from which we go one way or the other way, then we just simply go now the other way. Now we're looking for it to go below the 50, right? We're dropping through the 50, and then we sell the 20. It hits the 20, we sell the 20s. We have a stop at 20 points above at 40. Now, by the way, is that an ideal stop? It's not. Is it, are you going to get stopped out a lot? Yes, you will. But you have to, and this is the key thing, in trading you always have to compromise between risk, reward, and entry. If you really were intelligent, you probably would put the stop above the 50 because that's sort of the natural marginal line. The problem with that, though, is that you're assuming way too much risk for the edge that this particular setup works. This setup, basically, the way the setup works is it's either going to work or it's not. So the more stoppage you give yourself, all you're going to do is give yourself more losses. That's the interesting thing here. Yes, it's not a technical stop. Yes, it's not an intelligent stop, but it is a money stop. And money stop in this particular setup is the most important stop. I just want people to understand that because I'm sure people are going to tell me, Boris, this seems arbitrary. Why are you using 20 as a stop? You're getting yourself out at 40s. That's really kind of a stupid area. Prices can retrace into 40s at any time. Indeed, I understand. But the benefits outweigh the risks in this particular structure. So it's the same kind of idea. 20 to 00, I take half off, move the stop to break even, and then try to target 60 on the other side of the 00. So the minus 60 level. So if I'm doing plus 40 to the long side, I'm trying to target the minus 60. So here's a couple of shorts, right? I'm selling 103.20, target 103. Boom, right? Takes about an hour. Done. I'm done on the trade. I am. What is this? I think she got stopped. Yeah, this is a stop. So this happens, yes. So these are Kathy's charts. That's why I never. This is e-signal. This is e-signal charts. That's why I'm so unused to them. So she sells 15.20, right? And she gets tripped. It happens. No problem. It gets retraced back out. You're done. But here's the thing. Here's the thing you need to understand. It's not like giving you a wider stop here would have made it much better, right? Why wouldn't it have made it much better? Because all you would have done is just lost more money. You just kept going against it. You'd never dropped below 20 for like a long, long time, right? So it's not like you gave yourself any better opportunity by widening the stop. So this was a stop out. So here's a chart that I made for you guys that explains the whole reason for why you do this, right? And the key thing about this is, number one, you got to trust the setup. Number two, you got to take it as it comes, and you're going to get stopped out, and you're going to just bounce back and trade again. Because the whole idea here is look at this particular trade. This is a typical day in the life of the pound. Enough to drive everybody batty, right? Enough to drive just even the most seasoned traders batty. It looks completely bearish in the morning, and looks super bullish at nighttime. I'm sure some of you guys, I'm just curious, how many people here in Australia have like sold the pound, gone to sleep thinking, oh, this looks so bearish, I'm going to wake up with a 100-point profit, and then wake up after, when you've slept through the New York session, only to find out the whole thing just ripped you in the face and went 200 points the other way. How many times does that happen to people in Australia? I'm just actually curious. This is pretty much everyday occurrence in the pound, right? This is what the pound does to all of us. Anybody? I'm actually curious. Anybody ever have that happen to them, Anthony?
Seems like half the room.
Exactly. Welcome to the point of pain. But here's how we can get control over the pound, our most greatest nemesis in the currency world, right? So here's a trade. Here's a way where we follow the 00 strategy religiously to the rule all day long, and you can see why this particular structure is so valuable. So here, I sell a 20, I cover half of the 00, right? and then the other half at 60, right? Boom, I'm done. I've now made 80 points. Huge, 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 right? Next, it drops below 50, then bounces back up, does a false breakout. I buy the 80, I get stopped out. Now I'm minus 40, right? Then it does a second buy, right? At the 80. I buy it. It comes back out, stops me out, so now I'm plus 20, right? So now I'm 80, minus 40, plus 20. Next, it does a third move through the next level. I buy the 80 of the 24 80s, right? And because the price really continues to verticalize, it hits, by the time it hits 25, it never comes back down to 80. I'm able to hold on to the second half for 24.40, right? And this is the essence of why this setup is so valuable. It's looking for that big move. What is so rare, and this is, people always tell you, oh, you got to trade with a 2-to-1 risk reward ratio. And those of you who are in my trading room know how much I laugh at that notion. Nobody ever can effectively trade in the currency market with a 2-to-1 risk reward ratio because the market just doesn't give you $2 for a dollar worth of risk. But, and this is the beautiful thing, occasionally, if you can ride the wave, right, you can catch that 2-to-1 total ratio on the second half. And you can do that for two reasons. Number one, because you're financially protected, because remember, this is all risk-free money. The move, once you hit the 2,500, you're now at break even. So whatever happens here, it's all risk-free money, right? And psychologically, you'll never be able to hold on to your position if you haven't taken some money off the table. That's the key thing. So it's both psychologically and financially the only way I know how to get close to 2-to-1 risk reward, which is what essentially what this works out to. You're losing 40, but occasionally when you hit that big home run, to use an American sports term, you're going to hit that 80, and that 80 is going to pay for a lot of bad stop outs, right? In this particular case, there was an extraordinarily rich day when we made 140 pips in one day in the pound. Really, really nice, right? So there's another variation that I actually like a lot, really like quite a lot, which is some of you guys are what I call bargain hunters, and other you guys are momentum chasers. So this is a trade based upon, you buy higher to go higher, right? Or you sell lower to go lower. That's a momentum trade. There are people who are psychologically predisposed to doing that. It works great for them. But there are other people, there are people who literally, cannot bring themselves to pay $5 for a cappuccino, right? It pains them in every part of their body to pay, or this is my other favorite, is to pay $5 for a bottle of water at the airport. I'm actually curious. Are the prices at the Australian airports in a complete different reality than they are at the rest of the world, like they are at American airports? Like an apple in an American airport, which costs 50 cents everywhere else, will cost $5. So, for people who are frugal, I don't think there's a greater torture in life than the American airport. I'm just curious if in Australia it's the exact same thing, that prices literally are 500% higher somehow in the airport bubble than they are in the real world. So for those people who literally just cannot bring themselves to buy higher and buy this, the value version of this particular trade is to buy at value. So the way that works is very simple. Suppose the price rose, right? Sorry, let me make sure this. So the price rose to the 00 level, and then it drops down to the 50 level. It drops down to the 50 level, right? Here, we buy as a bargain. We say, okay, it's made a correction. I'm gonna make a stand here. I'm gonna buy the 50, and I'm gonna bet on the fact that it's gonna bounce back. And if you bet on the fact that you can bounce back, again, you work the same idea. Half off at 70, and then you target 60 points on the rebound, and trail the rest by 20 points. It's exact same structure as you do in the other way, but instead of doing a buy stop, you're doing a buy limit. You're buying when the price comes back to you, and that actually works really, really well in multi-day, long-term trend type of trades like the yen, where the yen will go 1,400, come back down to 1,350, right, and then will bounce back up. and you were able to buy it at 1350, and then maybe the second wave takes you for a plus 60 trade, right? So here's one where where is this? This is the yen, right? So 14 comes back down to we bought at 1350, right? Stop is at 30. We buy right here. It's actually very almost doesn't even. It only goes like 10 points against us. We sell half at 70, and then you can sell the other half at 90 for a plus 60 on the full trade, right? Really nice kind of a bargain hunting view, right? Big move up, and then you just buy the 50 in the other one. So for those of you who just can't bring yourself to do buy stops, here's a way for you to do buy limits. And similarly, the same thing if something falls, right? If something falls all the way down, right? So here's a move where the trade falls all the way down to 1290, right? And then it bounces back up to 1350 right over here, 113.50. You sell the 1350, right? You sell the 1350 here with a target of 1330. Boom, done. And then then it's the weekend and it gaps up. But the point is that by the way, this is actually a super great chart for me to give you a big caveat. So if it's the weekend, right? Let's say you're in position. Let's say here's a good example. We sold the 1350s, made half our money at 1330s. Stop now is 1350 at break even, right? And we're coming up against the weekend, right? What do? Boom, get rid of the whole position. I don't even if I'm in a loss, I get rid of the whole position. Why? I never hold money over the weekend. I'm a day trader. So again, this is just particular to me. I never hold money over the weekend because of this. This is what's called the gap risk. Because the next, my Sunday night to your Monday morning, Auckland suddenly decides, oh, I'm going to raise yen 50 points off the close, and my first trade may be, minus 40 on a position or minus 50 on a position, and I don't need the headache. So it doesn't matter where I am. By generally 12 noon New York, I'm flat. I never hold anything over the weekend. So it's just an interesting adjustment while you're trading. Let me stop here for a second, see if there's any questions.
Yeah, we have quite a few here. The first question was, if you're stopped out, do you enter the same trade again if the price comes back to the original entry price?
Yeah, baby. Yeah. Let's go. Let me show you exactly. You gotta believe. Hang on. Let me show you the chart. Right. You gotta believe. So I am 2380. I buy it. I'm stopped. Right. Right. I'm stopped out. I'm sorry. I'm stopped out over here. Right. 2380. I buy it again. I buy it again right over here. I buy the second one right over here. So I go right back in. Thank you, sir. May I have another? Now, I get stopped out twice in a row. Maybe I'll, just pause for a day and just walk away. It happens. What I would say is, if I get my maximum point of pain, my absolute maximum point of pain is 3 stops in a row. And it's not, it's not like it's some kind of a mathematical rule. It's just a psychological rule. Sometimes the market and the pound can be that cruel to you. There is actually, we have a much more sophisticated version of this strategy. I'm giving you again the simple recipe from which you can base a more complex strategy off of it. We have a more sophisticated version of the strategy that does a continuous trail stop behind it. That requires a specialized EA that we have in my room. Those of you guys who want to come join me in my room, feel free to to come in and trade with us at BK Forex. But even on a simple basis, this works. This basically on a simple manual basis, without EAs, without anything else. You just have to believe in the setup and do it again. Yes, 3 strikes and you're out. I would stop at 3 maximum. Generally, what you'll find is that cable will sometimes fool you once, but on the second time, the wave goes up, and the wave takes you higher. And by the way, this isn't, of course, in any way, shape, or form limited to cable. This works very well in the euro and all the other, pairs that this trades on. Let's just let me actually see if I can. we're so behind. Guys, I hope you get willing to hang out with me for another half hour because I still got a little bit more to tell you. But and as I said, I will stay with you as long as you want, because I really want you to absorb these concepts. Okay, so this is the euro. Let's go to 15. I just want to show you from yesterday. So this is yesterday's trade, right? So euro starts out 105.20. We get, again, miserable day for the dollar, positive day for the dollar. Early in the morning, the dollar gets completely destroyed, right? And so around 11 o'clock in the morning, New York time, 1580 gets crossed. So you buy the 1580, and within about an hour and a half, it hits 106, right? Actually, this is the key thing. Never hits 1580. Never. It just comes in 1581 was the bid. So especially if you're trading with Pepperstone Razor, your stop would not have been hit. How is that for a great plug? So you avoid the stop getting hit. You're break even, right? And you can see the trade just continues to move. It went to plus 40, and ultimately, actually, as I can see, at 4 o'clock in the morning, it hit that plus 60. It made that golden 80 points for you that you wanted on the trade. So so very cool. Very, very cool, especially if you're a Pepperstone customer. Okay, so any more questions? Let's go through the OO questions. Anything else, Anthony?
Yeah. Do you touch crosses like pound yen at all?
No. Okay, so great question. So I like to trade pure. You can expand your arsenal, but what you're going to find is that it's not going to be nearly as accurate because the cross, by definition, is a hybrid product, and it's going to have some forces of buying and some forces of selling weighing on it. Occasionally, the crosses really have a uniform one-way movement, but it's not every day, right? And that I just simply prefer to stick to the majors, and within those majors, really, the bread and butter of this routine is euro yen pound. That's where the bread and butter is. You can add the Aussie to it, you can add the Kiwi to it, but you'll probably die of boredom trading those. But that's really where the money is at to me. Don't get crazy. Bruce Lee said, "I never fear a man who try to learn 1,000 different punches. I always fear a man who try to learn one punch 1,000 different times. Focus on one thing, learn how to do this right, and then you'll be able to master it and expand it." Any other questions on this?
Yeah. So with these levels, like the 80 levels and so forth, it could hit those prices many times during the day. So there's two questions based off that. What's the general rule when it comes to which pairs to trade at which time? And do you have any EAs that automate this?
The pairs would be euro, pound, and yen. The best times of the day. Although this is the key thing I want everybody to know. This is not nearly as time sensitive. It is, it works best as always between 7 o'clock in the morning New York and 12 in New York, right? Everything works best during those times. But it's not like in Asia they can't take out the O levels. It's not like I haven't seen it done. I think this is not nearly as time sensitive a setup. It's much more of a price sensitive setup. Once they get close to that level, they chomp at the bits. The dogs begin to run wild towards that level. So once you get close to that level, what you're assuming is that within an hour or two they're going to try to break it. That's your underlying assumption on the level. Also, during the quiet hours, like Asia, that 50 buyback level is excellent. Both as a retrace on the shorts, as a retrace on the longs. It's an excellent entry point for Asia levels. And yes, we do have the EA that automates this. Yes, in my trading room. Yes. Anything else?
One last one for this. Time frame, the time frame on the chart itself, does that matter much at all for this?
No. I use the 15-minute just to give you, again, everything is price driven, not time driven. It's time of day driven and price driven. That's the key thing. That's the key thing. These are the time driven setups are almost exclusively indicator dependent, right? So one of the things that I want you to sort of take you out of that whole mindset is that there's no indicators here, so we don't really care about time, right? Because indicators depend on time. We don't depend on time. We depend on price. So that's the approach I want you guys to think about when you're trading this. Any other questions?
I think we're good to continue on.
All right, guys. One last session. One last. Trust me with this. This is a goodie for those of you who like to do a little bit longer term. So just bear with me, and I'll try to go through this as intelligently as possible. So the last thing I wanted to share with you is how to trade naked with swing patterns, right? And swing patterns are basic. We all know them. Let's just take the basic double top, double bottom, right? They're there. They're there for the taking. They're simple, right? I have a way for you guys to trade this that I think makes imminent sense, incredibly simple, and hopefully as high probability as anything that you've seen. Basically, first of all, we determine what is a swing high, swing low. And it's one of those kind of things that you can only do visually. I can't textually explain to you what a swing high, swing low, but you guys know instantaneously what a swing high, swing low is on a chart, right? And it's visible because you can see it. It's where was the prior high, and then the price went down, and then now you're going up towards that prior high or prior low, right? So what we're going to do first and foremost is, let's say the swing low is at an XX point. We're not going to be that smart. We're going to say we don't know if they're going to run it to the swing high, swing low. We're going to take the the higher probability bet that they're going to run it close. It's called the neighborhood play, right? We're going to get into the neighborhood. We're going to get into the neighborhood of the swing high low by going 50 points below the swing high, 50 points above the swing low to get ourselves to establish a position, right? We're going to put a stop, and this is the single most important thing. Single most important thing. Again, goes back to my whole idea of 20-point stop. Because there is no point. You ever gone on a really bad date? You ever gone like on a date with somebody who you just have no chemistry with, no interest with, and within 5 minutes you're like, I'm gonna blow my brains out. I can't be here, right? What's the right course of action? It's not to be polite and sit through like a really torturous long dinner. It's to say, it's to make up some bogus excuse. Oh, I'm sorry, I have an emergency call. I absolutely have to go. Trust me, you're doing yourself and the other person a big favor. This is the same thing. Leave at 100-point stop. You will do yourself and your account a big favor. Okay? It's like a bad date when you're beyond that point. So a stop at minus 100 of the swing low to the swing high is all you need, which means that the maximum risk I'm going to give myself on this trade, always, forever and ever, is 150 pips. What I'm basically saying is, if they're going to push prices 100 pips above the swing high and swing low, I am so wrong. I am so wrong, even if I'm right, that I want to be out of the thing completely. And then you can scale it up to you whether you want to just add to the position in between those levels and scale out if you like, or you can just do a single entry, single exit. So here's swing low, right? Here's prices in dollar yen, right, at around 113. Then they rise all the way up to 116, right? And they start coming down, and you see that the 113 obviously is the is the natural. They spent the whole month of August basically at the 113 level, right? So now that it's coming back down towards 113, you're going to say, okay, I'm going to make an educated guess that there are buyers at that level. I'm going to buy, I don't know, 1350 with a stop at 112, right? I'm going to put a stop at 112 right underneath here. I'm not being precise here because it's a little hard for me to see the exact numbers. I think the stop would actually be like 1150 because the swing low is 1250. So I would actually be a buyer at 1300, right? So I'm a buyer at 1300. My stop is at 1150, like right underneath here, right? And let's say I'm just holding on for one. I'm doing one and one. If I do 1 and 1, so let's say I go 100 points forward and I put a stop to break even and just simply hold on to the position, well, I have a chance to make 300-400 points here, or maybe if I get lucky, I get a second chance here. And this is the other interesting thing. So in the first trade, I buy here 1,300, stop at 1150, target 100, and and it goes, and I make money, right? Now it rises and it comes back down. It comes back down, back to this is already a whole month worth of trading, and it's coming back down towards that 13 level. And I'm like, okay, you know what? I'm going to buy 1350. The low here was 1,200. No, low here was 1,200. So I'm going to buy 1,250. I'm going to buy right here, right? Because I can't guarantee it's going to go touch the bottom, but I'm going to give myself 50 points above the bottom because that's a reasonable place. And then boom, and it takes off. This is obviously a doctored up example. I mean, I chose the absolute best example to kind of show you, but the structure, the actual discipline of the structure is incredibly powerful. It's all about buying at key support levels, all about not spending any more budget on your stop than necessary, and then either doing a 1-2 exit or just a simple 1 exit. And this is all done on daily trades, so you obviously have a lot more time to work. Here's a good example, Euro Yen. Now somebody was asking me, crosses. This is one area where I'm actually perfectly willing to trade the crosses because this is daily charts. There's massive, important levels of resistance and support on the daily charts, right? And I'm going to trade it. I'm trade it against those. So here, what was that? The high here is 17. I'm a seller 1650 with a stop at 1800. It comes back down, right? You could trade it both the other way. The low here is 13, right? I'm a buyer 1350 with a stop at 1150. I survived that. It goes back up. You can do this all day long, except it would be all month long. It's basically sort of a 1 or 2 trades per month that sets up given the charts. But if you use this particular structure, it's imminently intelligent to do this. Here's the Australian dollar. By the way, coming up right now, where are we at now? 77s. Am I a seller at 70? Hell yes, I'm a seller at 77s. The highs here is basically 77.50, 78s, right? So if I'm a seller at 77 with a stop at 78.50, do I have a reasonable chance to, get 76? Probably, right? So I'm a seller. I'll be a seller. Here's a range in the Australian dollar clear range at 74.50. Am I a buyer at 75? Yes. I'm a buyer at 75 once. I'm a buyer at 75 twice. 75 drops. It takes me out. I'm stopped out. Great. You know why? Because I would be an idiot to keep buying this because what actually happened is, yeah, it had a small retrace, but it actually basically went on a massive decline after that, right? So it's what's called buying a falling knife. This is why I have my 150-point stop. If I get stopped out, you could also, by the way, there's just sort of a simple idea that I just thought of right now. If you get stopped out in this particular setup, that's actually a pretty good signal to you that there's a massive trend change, that there's no longer support. Then maybe any kind of a bounce back is an interesting short with the same idea. You kind of short back into the congestion area with a stop 100 points above the congestion area, so with a stop at 76, and then you just simply run it the other way. You see how simple, easy, and efficient it is to be able to structure these trades, right? So, sorry. So this is all swings, right? These are all the swings trades. Let me just sort of stop right here, and then I will. I just want to do a final review of the OO trades. So, everybody clear on trading the swings? Find the clearly visible highs and lows. Establish a position 50 points in front of those highs and lows. Establish a stop 100 points above the ultimate highs and lows to give yourself basically 150-point maximum stop risk, and just trade away. Any questions, guys?
There's one question. Due to the size of the stop, is there a general rule to follow as to how much to risk in regards to lot size per trade?
Absolutely. So, it's probably I think it's probably going to make a really great webinar in our future series about how much money do I risk. But what I tell you is that the short answer to that question right now is I would not trade more than 1 times your equity. So that means if you have a $10,000 account, your position on this particular, or maybe 2 times equity, you should trade 2 mini lots, $20,000 worth of positioning. If you have a $100,000 account, you should maximum trade 200,000 units of the position. Okay, that's going to be probably a big shock to all of you, but that's really a conversation for another time. We should definitely do a webinar about money management because I guarantee you I will change your life when we talk about those things. But that's the short short answer of what we do. Any other questions on that? Everybody
Yeah, it looks like
everybody clear on the swings? I just want to make sure on that. Yeah.
I think this sort of relates to the swings. Another question came in. Looks like we're concentrating on daily charts. How strong would support and resistance levels be on lower time frames?
Much weaker. That's why I gave you the daily charts. What I gave you here, there's a reason why I gave you this, because it's much more meaningful, right? I mean, what's a 5-minute support resistance? Noise. What's a 10-minute support resistance? Noise at 10 minutes. An hourly, maybe a little bit less noise. But the point is, I don't know how to trade those time frames intelligently. Maybe you guys do, and maybe we can come up with a good strategy. I don't know how to trade those time frames intelligently, like this. This is an intelligent strategy because this takes in all the available information to all the market participants and puts you into the proper posture, both trading-wise and money management-wise, and how you want to manage it. So let's move on because I'm definitely way over time. I just don't want to keep you guys any more here than an hour and a half. So let's just understand the perfect OO setup. And then, once you understand the platonic ideal, we can all go into the grubby, dirty little world of trading that we live in, right? So the platonic ideal of the OO setup is euro, yen, pound, high volatility pairs, right? Trading the 50 retrace is a very, very legitimate trade in especially the yen. In anything that has a long-term established trend, the 50 retrace trade is quite good trade, right? And what you want to aim for in a perfect world is the big gain, that 80-point gain, the 20 plus 60. If you can get that one out of four tries, you are money. You are money, because that pays for a lot of mistakes and that produces the really, really good profits, right? Right? So one of the reasons why I absolutely hate trading the Australian dollar for this particular strategy, as you can see, is it's a recipe for disaster. Stopped, made money, stopped, right? Why? There's no follow-through. There's no follow-through anymore, right? It's an incredibly low volatility pair, right? It's just simply, a pair that does 100 points in a week is not a pair that's going to give you those explosive OO setups, right? To move an Aussie a penny these days requires, the power of Hercules. So that's why you don't trade the Aussie, you don't trade the Kiwi, you don't even trade the Caddy anymore. Dollar CAD is no longer a big trade. I'm just simply saying stay to the majors. Those are the ones that you want to trade well, right? And this is Japanese yen. You can see the huge difference. These are all positive trades. These are both retrace trades and the OO trades that you can take. This is me selling the 50s, buying the 50s, buying the 50s, buying the 50s, getting stopped out here, buying the 50s, buying the 50s. You can see how much better probability ratios I have here. This is basically 1, 2, 4, 5, 6 against two losing cycles. Much better, right? So in an ideal structure, let's say I have 4 trade cycles, right? In an ideal structure, well, I have 3 trade cycles. Simple. 1 loss, 1 small win, 1 big win. That's almost never going to happen, right? In reality, what you're kind of hoping for is two losses, right? Two small wins, one big win, and then you make 40 points. You can achieve that, you're doing really, really well. That doesn't seem like extraordinarily a lot of pips, but my God, if you can do that every 2 or 3 days, trust me, your account is really going to do well. So hopefully you guys enjoyed this. I think, I've given you some really good tools to go out there and experiment. As I said, anybody who wants to come in, hang out with us, just go to bkforex.com and just hit the join us button, and you can come in and trade with me in the room. We do have, obviously, more sophisticated versions of a lot of these ideas that we trade there, and I'd love to have you. Any final questions? Anything else on their mind, Anthony?
Just for all the attendees, there have been a lot of requests. Yes, we are going to send you the link to the recording. Just hang tight. Give us about a day to produce it, and we'll email it out to everybody. And for you, Boris, thank you for dropping your trading room link. A lot of people also want to know if they can have an email where they can email any questions to you.
Yeah, let me. The email is right here. Sorry, the last slide I forgot to give you. Email. This is where you want to reach me. contact@bkforex.com. Okay, always, that's the single best place to reach me. I'll always answer your emails in that email. I don't know. Guys. I can't promise you because I got to speak to Natalie whether she wants to do this or not. But I'm more than happy to PDF this PowerPoint, and if when they email you the link to the video, if they want to email you the PDF, I'm happy to produce it there. So I can't promise you, but I'm more than happy to make that offer to her, and we'll see if you guys will be able to get that. Okay.
That sounds good. A lot of requests for PDFs as well, so hopefully Natalie agrees to
to accommodate us all. So that's it, guys. I thank you so much. Hopefully you guys enjoyed it. This is our first of a whole series of monthly webinars. By the way, if you have ideas for what you would like me to talk about, email me. I'd love to hear it. It's a totally open-ended series. There's no agenda here. So if there's something that's really of interest for you to discuss, email it to me, and maybe we'll make it a topic of conversation. So I will see you guys next month. Thank you, everybody, again for attending. And I'll try to be a little briefer next time. But these are such good strategies that I really want to take my time in discussing with you. So I hope you guys all enjoyed it. Thank you so much for hanging out with us. And I'll see you in the markets.
All right, Boris. Everyone wants to say thank you to you, and I'll stop the recording now. And again, the recordings will go out soon, guys. Okay.
Thanks, guys. Take care.
Thanks. Bye.